Good evening, everybody. Welcome to Zoom at 8. My name is Julianne Peterson. I am your host every Tuesday night for Zoom at 8, as well as a senior director, loan officer for Old Capital Lending. You know, Old Capital's been in business for 38 years. We have closed over 7,000 loans, which is a lot for a broker. And we typically every year we close about 1.2 billion. So that is even more than some lenders out there, direct lenders. So I want to be your lender of choice. So if you're looking at something that requires agency, CMBS, bank, or bridge, I can help you. So if you're looking at it and you're thinking, hey, I want to put in an LOI, I'm going to need your T12, your rent roll, the offering memorandum, if it's available, and your underwriting. And we will take 48 hours and we will vet it with appraisers and we'll vet it with a lender so that when you walk away to put in an LOI, you are very clear what the proceeds are. In this environment, we're going to talk about this tonight. This environment is difficult for capital raising. The equity on the sidelines is massive, but it's for a lot of institutional deals. And some of us that are getting used to underwriting and getting into deals, it might be more challenging. So you want to make sure that you're paying the right price for this asset. So send those over and we'll set you up with the right indication. All right. So tonight I am excited because Andrew Cushman was here, I think 4 years ago. So a lot has changed. His story is the same from where he started, and we're going to go touch a little bit about that. But Andrew says it like it is, and that's why I want him here to tell you. So for over a decade, Andrew has been growing real estate investment business full time. He started off in single family like so many of us, and he went to the depths in the depths of the Great Recession is when he was doing this. Andrew completed 30 single family flips, which is difficult on its own, and it's a ton of work and it's very profitable, but it's a lot of work. It's a job. But in 2011,
Not that
Andrew,
old.
oh boy, 2011, Andrew transitioned into acquisition and repositioning of multifamily properties. He acquired a mostly vacant 92 unit building in Macon, Georgia, and it was on the other side of the country from where he lives here in California. So that was his first deal. That property was eventually sold for much more money and for several extra, double, triple times what he paid for it. Um, Andrew now looks at assets that are in the Southeast, Class B, typically value add properties. And he's acquired and repositioned over 1,800 multifamily units to date. Outside the business world, which I think is so amazing, Andrew is a certified alpine ski instructor, and when not working in real estate, he enjoys surfing, backcountry skiing, and trying to not be outwitted by his two young children. So tonight is a great honor to have Andrew Cushman back in the studios on this live conversation with Zoom at 8. So Andrew, welcome back.
Oh, good to be here. And I apologize. Chrissy must have sent you a wrong info or typo or something. We're at 2,700 units. So we've done a few more since then.
That is
So,
huge. We need to update that bio. Well, so listen, Andrew, you started out as a chemical engineer, blowing up things. I
mhm.
mean, like, how do we go from blowing up things to reconfiguring assets? Now, I understand the fix and flip model, that's blowing up something that looked terrible to something that's a gem, but going to a 92 unit building, your first one by yourself with your wife in a place that's hours away on a flight. What are you thinking? How did that go? Tell us about it.
Well, I was a bit naive. That's part of why we ended up doing that. I would never recommend someone buy a 92 unit rundown, decrepit 60s and 70s property as your first deal. But the reasons for it is number one, the reason we went that big is because we knew we wanted because part of investing across the country is figuring out how to manage the thing.
Yeah.
And we figured, hey, if we get something that's close to 100 units, then it will support its own on-site management. We can hire a manager, we can hire a maintenance stat person, and then they can report to us. And so then that way we can manage this thing from California. So that's part of why we went for 92 units. Also, we bought that for 7,500 a unit, which, again, we were just it was cheap, right? We could pick up 100 units for 7,500 a unit. Of course, it was cheap for a reason. Um, and yeah, that was it. And in terms of Macon, Georgia, candidly, I don't buy there. I haven't bought there in a long
Mm-hmm.
time, and I wouldn't buy there again. But in 2011, we didn't have the screening procedures that we have in place now. And basically what I did is I just said, well, I know Atlanta's good. And then I got on LoopNet and just followed the freeways out from Atlanta and looked for brokers that had the most amount of listings. And at the time, there's this one broker who had like 80% of the market in Macon. Like, he really controlled that market. And so just started talking to him and looked at every property he came up with. And I think at some point he's like, oh, this sucker will buy this property from us. And, we made an offer and got it accepted and got some seller financing thrown in, and off we went. So, yeah.
So here you are, you were in vending machines and selling popcorn and doing fix and flip, and you're doing your being a chemical engineer, and you and your wife say, you know what, there's got to be something better. And you go into the single family, and what was it that you were looking for to go into multifamily? Because I think there's a lot of people here that listen and come to Zoom at 8 that are looking for something in their life for when they go into multifamily. A lot of us talk about, you
Mhm.
know, the tax benefits. I just love that piece of multifamily. But what were you looking for? What was it that made this like, okay, forget that other stuff. Let's go all in.
Yeah, so the progression was, stepping back a bit, was, I didn't become a chemical engineer just because I loved it. I knew as a kid I wanted to do my own thing. I just didn't know what that looked
Mm,
like. So I'm like, oh, if I become a chemical engineer, I'll always have a job and a decent income until I figured it out. So then
mhm,
got married. My wife had the same idea, same idea. So that's when we tried vending and flipping cars and popcorn and all this stuff. And then we figured out flipping houses. And so we went all in on that, did that for about 4 years. The reason we transitioned to multifamily is, 2009 and 10, we had really good years flipping, but we realized a couple of things. Number one, it wasn't going to last forever. Like,
mhm,
everyone else was starting to figure out that there was a lot of money in flipping and it was getting really crowded. Two, there wasn't a whole lot of equity left because the house price has come down 50, 60, 70% in Southern California. So finding houses with equity was getting
mhm,
really tough. And as good as flipping was, we were only as good as our last deal. You buy it, you fix it up, you sell it, you put a check in the bank, and you got nothing left to show for it, right? Not that
mhm,
that's a bad thing, but you're starting from zero every single time. And so
yeah,
we said, okay, this has been great, but what is the next big thing? And we said, well, everyone just got foreclosed on and can't buy a house for the next 7 years. Everyone else knows someone who got foreclosed on and is scared to buy a house. And we just had a huge recession, which probably means we're going to have a long expansion. So no one's going to buy a house. We're going to have an expansion with job creation and incomes rising. So rentals will probably do pretty well. Let's go do apartments. And so that's what we did. We went and we did find a mentor. We didn't just like randomly go
mhm,
out and buy 92 units, but it was a very intentional shift. And then part of it was, with an apartment complex, you buy it, you do the work of renovating it, so kind of the flipping part, but then you hold it for a while.
yeah,
And what it provides is residual income, residual cash flow, so that you don't have to do deals to survive once you get to a certain point. You can, when the market says, hey, deals aren't working, you can be patient and wait and not do deals for a while. And so it provides, residual income. And it's also a way of scaling. Would you rather own 100 houses scattered all around some city, or 92 units on one plot of land in one spot that you can hire two people to run for you, right? So,
So it took you about 6 months to find that first deal. I think you went over, I don't know, 400 deals you looked at. I can't remember the number, but you finally found this one and you put the money down, you syndicated that as I recall,
Hmm.
right? So walk us through because here we're in a similar situation where people don't didn't have a lot of money back then. There was people were, trying to get back either trying to figure out, am I going to get a new job? Can I, a lot of stuff that's uncertain back then.
Yeah, I mean,
Find, I'm seeing some parallels from when
there.
you were there and today. So that's why I want to make these comparisons. So talk to us about that syndication.
Yeah, I mean, and the good news is it would be far easier to get started today than it was in 2010 and 11, because back then real estate not only it was the cause of the great financial crisis, and it took everything else down with it, and everyone was justifiably terrified of real estate. These days, the only real problem was interest rate increases. That's what's causing the distress. The fundamentals of real estate are actually really pretty good. I mean, there's some pockets here and there with various issues, but big picture, overall, fundamentals really, really good. And so, yes, some equity has been scared away, especially if they invested in a bad syndication. But in talking with investors regularly, it's nowhere near as bad as it was back then. So if I would much rather try to get started today than in terms of raising equity than back in 2010. With that said, it's definitely going to be harder raising equity than it was 2 years ago. That's actually a good thing. But keep in mind too, and how we did it is we were again, this is part we almost didn't close the deal. It took us 6 months to raise the equity. We figured, well, we'll just go to our single family investors and that because we used private money for those flips and we'll see, get them to invest in the apartment complex. And we had a couple of people who said they'd put in big amounts, and one guy turns out he never had it. The other guy wanted to be a partner, and we're like, no, we're not going to be partners with you.
Mm,
And so it ended up being a much more difficult process than we imagined. It took us, like I said, over 6 months. We almost didn't close, had to extend twice.
mm,
Very, very difficult. But the good news is the first one that you do is by far the hardest. Once
yeah.
I mean, all you are probably quite familiar with Mike Becker. One of the things he says, it's an unfair business, and he's absolutely right. It is. The longer you're in it, the bigger you are, the easier it gets. The hardest dang part is getting going at the beginning.
Mhm.
So that's the good news is it can really suck to get started, but once you do and you make it over that first one, it's much easier from there on out. So
Well, you're building dreams for a lot of the people here. So I want to take a look at then. So let's finish up then, now, and the future. So then, you sold it 6 years later. You made quite a bit of money on that, as I mentioned. You bought it at a 75% occupancy. So you were,
vacancy,
I'm
75%
sorry,
vacant.
vacancy. Oh my goodness. So you were challenged on finding what lender you could use. Your mom helped with raising the money. She
She's
put
my
her
first check
first
ever.
money,
Yep.
right? You had some seller financing to kind of close that gap, which was amazing. Um, what are the things that you learned looking back? Now it's always easy. We have the conversations with Kenny McElroy, and he says, "Hey, if it's a good deal, the money will come." Back in the day, I'm sure you were sweating. It took you a long time to, close this thing. You're doing the renovations, you're walking the property, and you bring all your contractors there, you make some decisions. Then you have some vandalism on the property.
We did.
So
Yep.
talk about what happened then and how you mitigated some of the challenges. Because listen, this is, looking back, it was hard and we forget about it. It's like having a baby. Us women, we forget about the pain and suffering that we went through. And when you can look back and say, yeah, that happened, let's have it out. Like, what were some of the challenges? You're in a market, in a town that could be maybe some crime.
Hmm.
So let's talk about that. How did you mitigate some of that?
Yeah, I mean, this was in East Macon, which, I figured out later is a declining area. Again, not something we would ever even touch today. But Yeah, we one of the things we did when we were buying it is we walked into the police chief's office and said, introduced ourselves and said, hey, we're here and we want to clean this up and we want to work with you. And he just leaned back in his chair. He says, good luck with that. And like that was all he had to offer us. And we're like, okay, well, we'll come back and talk to you again down the road. We eventually did. In fact, you guys can't. I have a plaque on the wall. The local newspaper did we were on the front page of the business section for turning that place around. Because again, this was back in 2011 and 12 before renovating apartment complexes was something that everyone was doing.
Yeah.
But yeah, that was one of the challenges is, we had someone come in one night and rip the copper out of the wall. They didn't even bother to turn off the water. And so they also flooded the units. That was 4 units. That was $50,000 in damage.
Mm.
And, in terms of mitigating it, there's only so much you can do if you buy the wrong place in the wrong area. So, we had one area where people from the neighboring complex, which was a disaster, would come across the property line and into our property and cause issues. So one of the things we did first we put in a metal fence, which they just bent that open and
No,
come through. So then we said, okay, fine, we fixed that. Then we greased the poles,
no,
and then we also planted holly bushes all along the property line,
that's
which
smart.
which are super thorny, nasty, like you can't kill them, and that
Yeah.
actually solved it. Like people, they didn't
Yeah.
want to get grease on their clothes, and they didn't want to mess with the holly bushes. Um,
You
and
can't
then
read about that in books. I'll tell you that right now. That is awesome. All right, keep going.
then we also, and this probably is not new to all you guys either, but we got security officers. We basically gave
Yeah.
a local police officer, I think, either half off, or I think we might have even given them free rent to stay at the property. The deal is they had to be one of the police officers that actually got to drive their car home. So there's an actual
Mhm.
cop car parked in the parking lot. And then it was also their job to walk around the property a couple times a day, do all that kind of stuff. So that helped. And then candidly, the biggest thing to combat vandalism and crime is to just get the property full.
Mhm.
You had the more vacant you are, the more problems you have. And so once we got to the high 90s for occupancy, plus a holly bush fence, plus a courtesy officer, we no longer had the crime and the vandalism issues. But getting to that spot was definitely rough. So.
So you go out there, you have a property manager that you vetted, because here you are in Southern California. How are you managing that? How do you vet them? How do you make sure that you trust them? Because I think that is some of the challenge that people are facing today. They don't want to buy where they don't live.
Yeah, and that is the key to it is finding the right management. So actually the property manager the property management company that we used was actually a management company owned by my mentor.
Oh.
So they were the third party property management company, but I say third party, but it functioned as if it was kind of in-house, right? I just didn't have to deal with payroll and HR and all that kind of crap, which I don't want to do anyway, and or filing evictions or any of that kind of stuff. In terms of the property manager, we actually hired the property manager who was there when we bought it, because when we were touring and spending in the process of buying it, doing our due diligence, she had all kinds of ideas for how their property could be improved and what she would like to do and what she would like
Mm,
to see, except the owner wouldn't let her do anything.
mm.
Because this was okay, 92 units, they were collecting $8,000 a month.
Wow.
So, I mean, that just, and that would be a couple $100. They would take cash, they would take,
Mm,
whatever. And so we're like, well, we don't have anyone better that we're aware of. And she actually seems like she could be really good. And what happened is once we gave her some authority and some leeway to do things and the cash to actually make a difference,
yeah.
she owned that place. It was
Mm,
her pride and joy, because she turned it around and she took care of the community and she knew every resident. And so it was one of those situations where on the surface it would look like, oh gosh, there's no way this manager would be any good, but she
mm,
actually was held back so much by the previous owner that once we let her cut the leash. She had such high ownership of the property, and she cared so much. You can't pay for that. You can't hire that. It's really, that you just, I mean, skills are one thing, but the skills don't matter if the person doesn't care. And so
Yeah.
she actually ended up being a really good manager. We eventually, when we sold it, she actually got moved to other properties,
Oh,
because she
fantastic.
did so well. But I mean, it's not always going to work out that way. Sometimes, what if let's say we were, I was doing this for the first time, and I'm like, okay, this person truly is terrible, or like she's the reason this thing's in such bad shape. I would interview for for property management companies, and then let them bring candidates for management, and then I would interview the basically the finalists, right, and do it that way,
Oh,
which is
interesting.
what we've done on
Okay.
other properties. Yeah.
Okay. Well, that's good. That's a good point. So you you go on to a second one. You go on to a second deal in Macon, as I
Yep.
recall.
Hmm.
So you didn't learn your lesson on the first one. And in fact, I think you still own that property. Is that right?
We actually just sold it for, oh my word, like 5 times what we paid for it. So no, we
Amazing.
did learn our lesson. That one when we bought it was like 90% occupied, and it was on the good side of town.
Yeah.
So that's why, part of why we kept it so long is it actually just kept chugging along, and we're like, yeah, we'd already refinanced and pulled out like 200% of the capital, and then we sold it a couple of years ago now, actually,
Mm,
because we're just like, all right, we've had this thing for almost 10 years.
mm.
You do a renovation, the renovation only lasts for so long. Somebody else needs to come in and do the next value add. And we're like, hey, we can sell this for 5 times what we paid for it. Let's just, check that, put another check in the win column and move on. So, and plus
So
I was anxious to get out of Macon because I see that, the town's declining. So
yeah. So you had one good key there. You had said it was time to move on. How do you make that decision? How is it like? How long do you say that renovation will last? Because that was an interesting point. What is it? Is it 5 years? Is it 7 years? Do you have a statement for each of your properties? Like, what is that? I've never. That's a great point.
yeah, the answer to every question is it depends.
Oh
Um,
yeah, yeah. I use that
So
a
and,
lot.
and on the flip side, we've had properties that we said our plan was to sell in 5 years, and we still have them now 8 and 9 years in
Good. God.
because they're doing so well that none of the other investors or us wants to sell them. But you still have to come up with a plan in the beginning. And so the
Yes.
couple of factors that go into it, number one, what are the demographics of that submarket? Ideally, you're buying something, whether it's 5 units or 500, that's in a market that has growing population, rising incomes, and increasing jobs. And so if that is expected to be a multi-decade trend, then it might be an option to hold for a longer period of time. If growth is something that might be temporary, let's just say they're building a new plant and some jobs are going to come in, but after that, not much is happening. Okay, maybe you want to take advantage of that, but you're not going to hold for 2 decades. So number one is the demographics, what's happening in the market. Number two is your overall business plan. If you're just getting into the business, and one of the key things you need to do is build a track record. A key part of that is going full cycle on deals, which means buying it, fixing it, operating it, and then selling it, right? So in order to build that track record, you might sell in 3 or 5 years just for that purpose. And then so you start there, and then based on your expected hold time, then you determine your renovation. So if you're only going to hold for 3 or 5 years, you might use less expensive materials that are only going to last 5 or 7 years. However,
Mm,
I'll give a different example is a property that we own outside of Augusta, Georgia, where we knew we wanted to hold it for 10 years. So in that property, we did things like put in quartz countertops, which are almost indestructible. It costs a
yeah.
lot more money than laminate, and a little bit more than granite, but it's virtually indestructible. And so, because we knew like we don't want to have to put more capital into this over the next 10 years. So we also replaced some roofs when we bought it. And so now 8 years into that deal,
Mhm.
we've had very little capex because we planned on it in advance. So that's how you part of how you make that decision. If you buy something that's built in 1964 and do a quick cheap renovation, 4 or 5 years in, all of a sudden you're going to notice your recurring capex is getting higher and higher and higher, and your
Yeah.
NOI might look great. But even though that capex doesn't hit your NOI, it still hits your bank account,
Mhm.
and you still could end up you're still seeing yourself lose money every month or year because your capex is going. So it's all interrelated.
I love it. Most people are in this, they say 3 to 5 years. I'm going to get in 3 and 5 years. So let's switch now to now, right? That was then.
Mm-hmm.
Now, now we're not seeing the 3 to 5 year holds. What are you seeing? How are you structuring these deals for your investors? Are you now going to a 5 to 7 year hold or a 7 to 10 year hold? Kind of walk
Ours
us
is,
through that.
yeah, ours has always been 5 to 7 years and occasionally 10. We've never done a 3 year. The 3 year model worked great when we were in the musical chairs environment of 2020, 21, and 22.
Mhm.
And things are just, rising rapidly. Obviously, the music stopped, and we're seeing what happened with those. And the reason people did that is because you could, in a rapidly rising market, you could in 2, 3 years, you could pump out a sexy looking IRR. And most
Mm.
people were oblivious to the risk that was taken to get that. Someone posted in the chat, and I agree completely. I would run away with anything that's on a 3 year timeline right now, because
Mhm.
you know what the shorter the timeline, the fewer your options. The longer the timeline, the more options you have. And real estate is one of the few things where time is almost always your friend. It's been, at least in the United States, for the last 100 years. I don't believe in the U.S. you can find any 10-year period with for commercial real estate as a whole where pick a year and 10 years later it's worth less. Like, it doesn't exist. So if you can hold long enough,
Mhm.
you'll be in pretty good shape. So when we're looking at stuff now, candidly, I am really excited about this year. I see I pricing for multifamily is down probably 25-30%. Not everyone agrees with me, but I think we are at bottom in terms of
Okay.
pricing. And if I can go into multiple reasons why, but I very much feel like we're at bottom. I know I'm not saying prices are going to start going up tomorrow, but I do believe we're bumping along bottom. And I think that for 2024, 2025 is going to be your opportunity to acquire as much well-located multifamily as possible, to position yourself for the next upcycle, which I'm expecting in 26, 7, and 8, because we are heading into an even more exacerbated housing shortage when we get to that point. And rents and values are projected to rise significantly when we get there, even if interest rates are still where they are today. So, Julie, you wanted to say something?
Well, I'm just thinking, well, and that point, are we at the bottom? I think that's on pricing, right? I
On
think there's,
pricing.
right?
Pricing.
So we talk about the forward curve. I loved your comment on LinkedIn. And by the way, everybody needs to connect with Andrew. He has some very compelling comments and posts that get you thinking. Like, you might be coming into this conversation and going, "Oh, no, no, no." But Andrew will pick it, pick it apart, and you'll be like, "Oh, yeah, 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 that makes sense." One of the things that I do when I have a conversation with an investor is talk about the forward curve. And the forward curve, while it's way out there, it'll take you out, even 20 years. You look at what's happening, and everything is speculative when it gets way out there. But if you look at what's happening in the next 3 years, it's saying a very little bit of a decrease on the rates, but then it's on a forward trajectory, not a lot, but when we talk about interest rates, everybody's belly aching about the interest rates. I want to hear your thoughts because I think we're aligned on this, that if you buy it right and you're putting the debt on it that makes it work today, it's going to continue if you're using the right increases on rents and on expenses. So kind of walk us through your thoughts on the forward curve and how you're looking at deals today.
Yeah, in terms of interest rate, yeah, you're right. Everyone's belly aching about rates. Rates are finally just normal. Like this is
Yeah.
where they normally are. I've got loans from the 20 teens that are in the fives,
Hmm.
and now I'm like, oh, well, if I were to sell, my yield maintenance or prepayment penalty is almost nothing because rates are in the fives or sixes. So,
Sure.
and those deals are great deals. Um, in terms of, and I don't know if everyone's familiar with the forward curve, but basically what it is, pick a like the yield on the 10-year treasury, which today is like 4.3 or something like that.
Yep.
What the forward curve does is it's a market prediction of what that rate's going to be for the next 10 years. It is always 100% of the time dead wrong, because nobody can predict that. We're lucky to predict where it's going to be 3 days from now. But it gives you an idea of kind of like overall market sentiment and what I would say the
Hmm.
highest probability outcome. Well, right now it says we already basically hit bottom on the 10-year, and it's going to hang tight for I think it was about a year or so, and then gradually
Hmm.
start going up. So, and will there be spikes and drops along the way? Absolutely. Nothing moves in a perfectly, straight line or curve. But the take home is, don't anybody who's hoping to be saved by significantly lower long-term rates is hoping against the odds. And
Okay,
so the
I want to pause you for just a second. So with that said, because there's a big push to go with short-term debt with a step down or even buy down the rate, because the thought of, oh, it's going to go down, we're going to refinance. I want to know your position on that.
Yeah, I mean, number one, you have to match your debt with your business model. So, if you're gonna sell in 5 years, you might not want to get 12-year debt, or something like that. So that's part of it. That's a good question. 3, 4 months ago, I probably would have said, yeah, that seems like a good idea.
Mm,
These days, I lean toward probably buying down the rate on a fixed product that's long
mm-hmm,
term, so that if rates drop, I can get a supplemental down the road, but
mm-hmm.
I don't have upside risk if they go the other way. So that's generally speaking is like the key that we found when structuring debt. And just so everybody knows, like out of our portfolio, we distributed more to investors in 2023 than any other year, because when rates were down super low in 2020 and 21, we number one, we did not predict this. We had no idea that the Fed was going to raise rates this much and all that. However, we
Mm-hmm.
just, what we found is to operate in term, don't try to predict things, but just look in terms of probabilities. We said, okay, it's 2021. Interest rates are at the all-time lowest they've ever been. So statistically speaking, in the future, odds are they probably would be higher than they are today. And so the odds of them being lower, which means below zero, by the way, that seems like a pretty low odds bet. So,
Mm-hmm.
okay, if it's most probable that rates are going to be higher, we're going to fix this crap. And so that's what we did. And then of course now in retrospect it looks genius, but we weren't predicting anything. We were just playing the odds. And so at this point, the same rule applies of just play the odds. And what does that look like if you're buying something? Well, again, you got to match it. If you're going to hold for 10 years and you know it, that factors in. If you're only going to hold for 5 and you know it, that factors in. But primarily, if we're looking at a property that qualifies for agency, we're going in with lower leverage agency debt, maybe 65%, 7 or 10 years. We're buying down that rate because if you're
Okay.
holding that long, it does pay off to do that. And oddly enough, in buying down the rate, for anyone who's not familiar with it, basically you pay some fees or points up front, and then they go give you a lower interest rate in return. But then by giving you a lower interest rate, it improves your debt coverage ratio. So then they will give
Mm-hmm.
you a bigger loan, which you
Yeah.
then buy down, and you can get a bigger loan that way too.
Yeah.
So we might go in at 65%, fix it, and then say, okay, then just run through the options. All right, well, we want to sell this in 5 years, and we're going to get a 7-year fixed loan. So 5 years from now, or let's say from here on out, interest rates drop. Well, 2 years from now, wow, interest rates are all the way down at 3% again on the 10-year. Well, what is the market going to look like in that situation? Well, if rates are down that much, that probably means cap rates are down as
Mm-hmm.
well. which probably means the value of our building is way more than we planned, we'll get a supplemental, pull out some cash. We're in a great position. I don't need to refinance. What
Mhm.
if 3 to 5 years down the road, interest rates have gone way up? Well, I'm in a good spot because I fixed my original loan. I'm cash flowing well. I can just either sell now or on assumption, which helps preserve building value, or ride this out. What if rates go up and stays that way and it sucks for the next 7 years? Well, 7 years down the road, that building is, if I operate it well, is still probably going to be worth at least somewhat more than I paid for it. And if I only went in at 65% leverage, I should still be able to refinance. It's going to be paid down to maybe 55 or 60. Again, if let's just say there's appreciation. So you're probably looking at trying to refinance at 55%. Even if rates are higher, you can still do that. Is that the ideal outcome? Are you going to post that on social media and say, look at my great return? No, but you're also not going to be going out of business, losing investors' money and
Yeah.
filing bankruptcy, right? So that's how you structure debt, is you just look at, okay, here's the most probable outcome. Here's the next, here's the next, here's the next. What if we ended up with these situations? Make sure that none of those is going to kill you, and then place your bet. So
That's fantastic. All right. So the big question is, did you use bridge lending?
we only used bridge lending on one property. And that's because we had to, because it had actually a new construction element to it. It
Okay.
was an
Yep.
existing property with some additional units being built, and this is what I mean. This is how things can go wrong. So it was part of our contract with the seller that that building, the new units were supposed to be completed 90 days after we closed. And then we were going to quickly refinance into agency debt as soon as that building was finished and leased up. It
Mhm.
took over a year to get that building done.
Wow.
Then, by the time it was done and leased, the Fed had already raised rates, I don't know, 300 or 400 basis points.
Yeah.
Now, thankfully, we had we get a 5 year bridge loan, and they said they offered us 75%. We said, well, let's go 65 just to be safe. So we went lower leverage. That's one way to reduce risk. Lowers your returns on cash, but also lowers your risk. And we bought
Mhm.
a 3 year cap. So
Yeah.
a rate cap which is basically an insurance policy against
Mhm.
interest rates going up. So we bought that rate cap for $46,000. It now pays us $50,000 a month.
Amazing, isn't it?
Yeah, and so and we're looking at refinancing. Thankfully the property's done really, really well operationally. It's actually ahead of pro forma. We have to refinance by the end of this year. If the 10-year treasury hits 3.8, then we'll be at a cash neutral refinance.
Mhm.
The value of the property has actually gone up, even though values overall have come down, because again, our NOI went up. And if interest rates were where they are today, we are looking at maybe about a 8 to 10% cash in refinance, but the
Mm.
market and the asset are still good, and we've done so well in everything else that we're fine. We'll just put the money in and keep it, which is what we plan to do anyway. So other
Fantastic.
than other than that, everything else is fixed. So
All right, real quick, investor sentiment, your investors. They're hearing, maybe they're in other assets. Are they excited about today what's happening to invest in your deals?
yeah,
What do you got?
there is, well, and this might be a little bit operator specific because again, we don't have any deals that are going bad.
Mhm.
So our investors are not getting any bad news. But with that said, kind of stepping away from just us, market investor sentiment really seemed to shift in, I'd say, December, when Powell came out and kind of made the famous Fed pivot and
Mhm.
said, we're done raising, and and all of that. I don't know if the cuts are actually coming anytime soon, but what
Mm.
that did is that shifted market sentiment. If you look at, the stock market has gone straight up since then. Almost everything has gone up since then. And I've really had a lot of our investors reaching out with, hey, when is the next deal? When is the next deal? So I do think investors, again, it's not as crazy as it was a couple of years ago, which is good for the long-term health of the market.
Yeah.
But for well underwritten, good, well located deals that have a good story to them and that are, have solid risk mitigation, the equity appetite is there. There is six last time. This is late 2023. There's $6.14 trillion in US money market accounts. The GDP of Japan, the third largest country in the world by GDP, is like 4.5, right? So there is more money in US
Mm,
money markets than the entire GDP of Japan. And the long-term median average in money markets in the US is just over 3 trillion. So that is extra 3 trillion is that's where all the COVID money went, by the way. It's now sitting in money market funds. That 3 trillion is going to come back out when money market yields start come down, if they come down, and they're going to go into real assets. Thankfully and hopefully not all multifamily, but they're going to come into places looking for yield, and multifamily is going to be
yeah.
one of those places. So
All right, let's talk about the future real quickly because there's some risk. A lot of people, we're going to see all the new people. A lot of people say, I need value add. I'm going to do value add. There was a definite shift into Bs. A lot of people can't afford the new people. We've seen a lot of interest. They would show up last 2, 3 years ago. I'm going to buy 100-unit building. Those people are now looking at 12-unit buildings,
mhm.
and they're looking at Class C, which is heavy risk. What do you see as opportunities in these heavy risk value add Class C deals?
Yeah, there's if you listen to most multifamily people, you hear the same thread. They start off in C, sometimes even
Yeah,
D, and then they eventually move their way up, right? And there's
yeah,
good reasons for that. Number one is once you operate enough C, you quickly get to the point like I don't want to do this crap anymore.
yeah,
I used to the cleaning lady threw it away one day, but I used to keep a little piece of metal on my computer tray that was a spent bullet that I pried out of the drywall of one of our properties, and I kept it on my desk as a reminder to never buy that crap again.
yeah.
But the reason we do it is because number one, those sellers will actually entertain us because no one else wants to look at those things. Number two, they're the cheapest things out there, so it feels affordable and attainable. Um, but looking back, one of the reasons we changed to Class B is because when we looked at our historical portfolio, the highest returns for the lowest risk and the least headache was our Class B stuff.
Yeah.
So if I was going to do it again, if I was going to start today, I would rather buy a 30-unit Class B that's
Mm-hmm.
value add than a 100-unit Class C or C minus, and take the lower risk, have the lower headache, and make just as much money doing it. So don't be put off by the fact that the pricing is higher. It's higher for a reason. It's generally better areas, generally better class construction, better tenants. There are some rare people out there. A friend of mine is one of them who just loves Class C. And if you're good at it, you have the experience, you have the wherewithal and the stomach for it, you can
Mm-hmm.
make a lot of money in it, especially at the bottom of a cycle, like right now where cap rates in Class C have expanded more than anywhere else. And that means maybe they'll come back down eventually. But if I was going to do it over, I just wouldn't even buy the C stuff. I'd just
Yeah.
buy smaller B and then keep everything else the same.
Great, great, great tip. Um, what are you finding your investors saying? Are they open to you going to a C class? Or are they like, absolutely not, I'm out. I'm not doing this.
Well, they've actually been conditioned now that if I were to
Yeah.
buy a C class, they'd be like, "Wait a second, this isn't what are you doing?
Okay.
This isn't your thing." So, the only time I would buy C at this point is if it was somehow again. So we have very strict screening procedures about only buying in neighborhoods with certain incomes, population growth,
Yeah.
etc. So that kind of rules out most of those Cs. It would
Okay.
have to be a C class property that the surrounding area is B or A, and we could take that C and change it into a B or A. Everybody talks about doing that. It's way harder than it sounds.
Okay.
It can be done, and if you do it right, you'll make a lot of money. But most of the time, it's a C in a C
Yeah.
neighborhood, and it's going to be a rough ride. So,
So are you limiting yourself on what age that you'll look at? Is it
yeah,
only,
absolutely.
so talk to us about that.
So, and this is another thing. So when, one of I'm sure you all have heard about the problems with insurance, especially
Yeah.
multifamily right now.
Yeah.
You will save yourself some extra headache by looking at newer Class B properties because a ton of insurance carriers right now just don't want to touch anything that's more than 25 years old. for a variety of reasons. Now, it doesn't mean you can't get insurance if it's older than 25, but it just gets harder and it gets more expensive. Um, so we will consider anything 1980 and newer. We strongly prefer 1990 or newer
Okay.
in terms of vintage. And if it's 70s or 60s, it's just an automatic no.
But you are buying in Florida, I understand,
Hmm.
and you're not going to go on the coast, which is excellent. But I mean, they have seen a huge increase on the insurance, and I really like your attitude about that. It's, you know what? It's cyclical and it will come back down at some
Hmm.
point, right? When is that? We don't know. So, how are you underwriting these deals real quick on IRR, cash on cash, and the expense ratio and rent growth? Really interested in that.
Market rent growth, meaning just, hey, you just buy it and do nothing. What happens to rents? Year one, we're doing 0%. Year two is 2%. Year
Mm.
three, 3%. And again, that's assuming you're buying in a growth market to begin with. So that's for what we're assuming for rent growth. Insurance, that varies massively by
Yeah.
asset class and location. I was just talking with our insurance broker yesterday, who's been our partner for over a decade now. He is seeing new carriers enter the market because premiums are so high and there's so much money to be made. So if we do not have a really bad year with hurricanes and wildfires this year, he's expecting pricing to come down significantly, and
Yeah.
he said he's actually starting to see it. So what we do is we assume insurance to be super high to begin with, and then just factor in 3 or 5% increases. But if you just start it super high, then you're okay.
Super high, like 25 a door or 19 a door.
Again, totally depends
So it
on the
depends on
age and the
yeah, sure.
market, but yeah, there's properties where the seller might be paying 800 and we're like, dude, we're at 15. Sorry, like at 1500 a unit for insurance. So yeah,
Yeah.
we're getting
Okay.
actual quotes and making from our broker, adding some onto that to start off, and then factoring in increases for
Okay.
insurance.
All right. So expense growth is what?
So we break it down into individual pieces. So the
Oh,
biggest
okay.
ones are wages, tax, insurance, and property taxes. And so
Mhm.
depending on the market, we grow those ones individually, and then
Okay.
for everything else, we'll throw in 2%. Now, I would not just take expenses and do 2% as a whole, because again, wages and insurance and taxes will kill you on that one. But if you fact, yeah, we you do the big three individually, and then maybe throw 2% on everything else, and that should get you pretty close.
That's a really dynamic underwriting tool. All right. IRR, cash on cash. What is acceptable to you?
So again, we're trying to go lower risk, which means we kind of go a little lower leverage, higher quality property. So we're generally underwriting to an IRR of anywhere from 13 to 16% on a
Mhm.
5 to 7 year hold. Average cash on cash over that period might be about 7%, and equity multiple anywhere from 1.8 to 2.2 in a 5 year period.
Yeah. So you're getting cash on cash at that high, huh?
Yeah, I mean, usually the first year is not too sexy. It might be
Yeah.
3 or 4% because we're doing value add.
Mhm.
But then it grows over time, and then you average out the 5 years, and it's 7%. And I mean that does not include profit from sale. That's additional on top of that. So
Okay. Last question, and then I'm going to switch it over to everybody else. Have you brought in these co-GPs, people to help?
I have not. So I have I have two sets of partners. So I told everybody how hard it was to raise money in that first deal. So I
Yeah.
said, okay, this is it. So I actually went to my mentor. I was like, hey, do you want to partner on some deals? And he said, so he actually agreed. We ended up partnering on 6 deals over the last, over a year period. We still own one of those. And then 3 deals in, two of my big investors came to me and said, hey, we want to actually be partners. So we formed a partnership. And so those have been my principals and partners ever since. And so no, we've never actually co-GP'd. It's just not something.
And you get everybody brings in the capital and it's smooth sailing.
Yeah, I mean, so my other principals, I mean, they put in some, but the vast majority, 95% of almost every deal is just investors that I've met over the last, no, let's see, going on 17 years.
Well, that's
You know,
fantastic.
one
You
at a time at meetups and, a quick
and
story. So
Zoom at 8.
yeah, Zoom it. So I went to, this was when I was still doing single family, but transitioning to that first deal, trying to raise the money. I met a lady at a just regular old real estate meetup down in Irvine, California, Orange
Yep.
County. Um, and she invested like $50,000 in that second deal that I did. So this was
Uh-huh.
like 2012. She's done really, really well over the years, and she is now looking to have us buy a property for her, and she's gonna be the entire equity check,
Yeah.
up to 15 million. So like that one person that I met at a random meetup in like what 13 no 12 years ago is now an investor who's saying, hey, I want to do one deal up to 15 million.
Yeah.
So you never know who you're going to meet and where that relationship's going to
That's
go.
right. Absolutely. Absolutely. All right. Well, we've got a ton of questions here. So, um, can you please ask about the strategies and approaches that you use to manage your properties? The strategies and approaches. That could go
So
on for a long time. So give us
yeah,
one or two.
that's a whole webinar.
Yeah.
So we do really what I would call hybrid property management. We have a third-party property management company that handles, like I said, evictions and when the lady's dog in 3C bites the guy in 5B, and like they handle all that kind of crap, right?
Mhm.
Payroll, HR, all that kind of stuff. However, we have our own internal asset management team that we do weekly video calls with
Mm.
the properties. We do regular site visits. We are very much involved in the management of the properties. We do team calls. So we do masterminds where we do something like this, and it's all the property managers and us and nobody else from the property management company. None of the
Mm.
regionals, no one else. So that so if you go to one of our properties and you say, Irma or Juliet, who do you work for? Oh, Andrew and Kelly and Vantage Point, right? They don't even, to them, they don't work for the property management company. So we
Oh.
have third party property management for all the nightmare day-to-day admin that is involved in property management. But when it comes down to the vision of the property, overseeing it, interacting with the team members, that we are heavily involved in. So it's really actually kind of a hybrid thing. And
Mm.
that the people that you have on site is probably the most important decision you make. And one of the biggest mistakes is people will buy a $50 million property and then say, well, I only want to pay $18 an hour to this person, and I'm going to stick them in here and expect them to run this thing like, to make me millions of dollars. No, find that, over budget for wages and go hire and pay the best you can, because that person makes more difference to the performance of that property than all the due diligence and research in the world that you can do. Nothing has a bigger impact than the person you put in that chair and how you treat them and how they do. So
I violently agree. That is amazing.
I don't think
Totally.
anyone's violently agreed before. I like
I
that.
violently agree. All right. So I want to ask you about crime. Paula wants to know every time I find a good property, once I check crimegrade.org or spot crime, I see a lot of red. So I know that you use some other kind of software. Maybe you could share with us what the thoughts are on finding about crime. How do you
Yeah,
look at that?
a couple of things. Number one, if you're seeing that much red, it's actually probably not that good of a property. I mean, that's just the reality of it. But also keep in mind there's some nuances to that. If you're near a large retail center, there's going to be a million car thefts breaking in, right? That get reported, so it makes the crime look high. What you really want to look into in crime, it's not just the raw numbers, it's the type. If you
Mm,
have, like, again, I mean, if the lady in the corner unit of the building calls the cops, every 3 days because she sees a suspicious person hanging out, then that adds to the crime stats, right?
yeah.
So what you want to look for and avoid is any kind of violent crime. That is the stuff to add because you won't be able to get insurance, and number two, you just don't want to deal with it. So if you pull up a property that has, it's a good property, it's built in like 95, and the incomes are good and the demographics are good, all those kind of things, and it's like, oh, the crime seems a little high. We'll go dig into the stats, and if it's just things like suspicious person or car break-in or something like that, that's stuff that you can fix maybe with adding some exterior lighting or maybe a fence
Yeah.
or a gate or some behaviors. Just stay away from anything that's violent or drug related. That's where you want to stay away from that.
Oh my gosh, you have dropped so many nuggets here. I could go on for hours. I don't think you want to do that. But Andrew, if somebody wants to, first of all, know more about what you do and maybe invest in your next deal, how would they go about doing that?
Yeah, so just Google Vantage Point Acquisitions. The website is vpacq.com. I guess I can put that in the chat. And then the only social media I'm on, as Julia has mentioned, is LinkedIn. David Green says I'm a walking LinkedIn, so I just forget all the
Mhm.
other ones and go with LinkedIn. And that actually is me in the posting and in the comments. So if you
Mhm.
post on there, that actually is me responding. So love to have conversations on there. In terms of investor lists, so we do 506B, which means we don't solicit, which means you have to be on our list in advance to see a deal. I'm not going to post it on LinkedIn or anything like that. So if that's a future interest, just go to the website and there's a little tab on there, and you can, there's a quick form that's like literally 2 minutes, and then you schedule a phone call with either myself or Anthony. And if we're a good fit, then you'll get added to the list, and that's it.
Well, it's great. I'm so glad that, you two are local. I'm down here in Carlsbad, so it's great to see an investor
Love
doing
Carlsbad.
things outside of the great state of California. Said nobody. Um, so anyway, thanks so much again for joining us. We really appreciate the support and the little nuggets that you've dropped. So thank you. You've been super helpful to our audience.
You're welcome. Glad to be here. Thanks for the invite.